So what is your price outlook for oil when, of course, we have the Omicron variant, not to mention the OPEC Plus meeting coming up?
Yeah, of course. So look, in terms of what we're seeing, the Omicron variant has really changed price projections and expectations. In terms of the impact right now, we've already seen the big sell-off on Friday, and then we saw the comments from Moderna CEO about vaccine efficacy yesterday. But really the question will be over the next 2 weeks, what actually comes out in terms of the studies, in terms of how Omicron behaves. We already have some news reports out of Israel where a preliminary study has shown that vaccine efficacy is actually pretty good. So it's dropped from 95% to 90%. And so this is the kind of news flow that we'll expect over the next couple of weeks, which will really determine how markets respond to this. Right now, it has assumed almost a worst-case scenario. But yeah, certainly the situation here is very much evolving.
What about OPEC Plus? How will that factor in?
Yeah, sure. So look, with OPEC Plus, I think there's clear argument here that they should pause an output hike when they meet later today and tomorrow. Look, the situation for us was already 60-40 after the U.S. alongside major oil consumers released strategic oil stockpiles. Now the case is even more firm, and we can see that with just how OPEC Plus have responded to the crisis, the pandemic that is. They've always been very conservative and very concerned that outbreaks can happen. And I think that would really make the case very clear for them to just pause output hikes right now.
When it comes to the broader commodities market, it has just been such a strong year. Are we seeing the end of that, particularly when it comes to prospects of a recovery for iron ore?
Sure. So look, with iron ore, we have seen a fair bit of volatility in the last couple of weeks. Like we saw prices drop to $80 a ton, and now it's at around $100 a ton. So there has been volatility, but with iron ore, it's very much going to be leveraged on China more than other commodities. Keep in mind that 70 to 75% of the world's iron ore imports go to China. So they really hold the key there. And in our view, the key thing to keep in mind with China is steel mill margins and what's happening on steel demand in particular. We saw the PMI result come out, and what was really promising was we saw the construction sub-index lift. Now, that's infrastructure related mostly, but that's very positive because infrastructure accounts for 30% of China's steel demand. And is that potentially offsetting what's happening in the property construction sector where the weakness has been quite magnified? And that also accounts for about 30% of China's steel demand. So, the key thing to keep in mind here is how China's policy works out over the next 12 months. And we have a key meeting in December, mid-December, where we'll find out where Chinese policy objectives are for 2022. But broadly speaking, we should see a gradual decline in iron ore prices as China's demand eases. That's our expectation. But what China does with steel policy output is going to be very critical. And of course, steel demand is another indicator we're watching very closely.
Quickly, Vivek, give us your expectations for gold demand.
Sure. So look, when it comes to gold, our forecast is for prices to move down to about $1,700 an ounce by the March quarter and remain flat there for the foreseeable future. Really, what's driving that is exactly what really came about this morning. We expect what's coming from Fed policy is a more hawkish stance, and clearly that's going to be negative for gold, and that's something that we expect to be a near-term wait. But come early next year, we think a lot of that will already be factored into the price. But yeah, we expect that news flow to be really critical right now in driving gold prices.